Hi, and welcome to the Stockscores Market Minutes for November 28th, 2014. This week I want to talk about tax shelters and leverage. Many investors will trade inside a tax-sheltered retirement account. Now, some of these accounts allow you to grow the portfolio without paying taxes until you make withdrawals. Others, while you may not be able to put as much money into the account as you might like, don't ever require that you pay tax. It's a way for the government to help you build a retirement portfolio. The problem with these accounts is that they don't allow for leverage. In a retirement savings account, typically you don't have the ability to leverage the performance in that account. Now, recognize that with leverage, you may earn a return higher enough to compensate for the payment of taxes. If you can leverage account 2-to-1, for example, in other words, if you had a $100,000 retirement savings account, but with leverage, you get $200,000 of buying power. Well, if you earn 10% in that account, you make $20,000. If it was in a retirement account, which was only half of that, $100,000, you make $10,000. Now, if you think about the cost to carry and the taxes you pay, in the retirement savings account, that $10,000 is tax-free, at least until you try to withdraw later. If you do that in the retirement savings or in the non-retirement savings account where you've got leverage, you earn $20,000. You pay tax on that, so maybe that drops down to $15,000 because of the capital gains exemptions and that sort of things. And then you've got some carrying costs for the leverage. Perhaps that drops your performance a little more, down to $13,000 perhaps. You are still better off than the person who is making those trades inside a tax-sheltered retirement savings account. So don't think that the only way to plan for your retirement is in these government-sponsored tax-sheltered trading accounts. If you can manage risk effectively, and that's a real big question, but if you can manage risk effectively, you can actually earn a greater return outside of these tax-sheltered accounts because of leverage. Now recognize that leverage is a double-edged sword. You should never leverage if you are not an excellent risk manager. I really want to stress that. Leverage is a great tool, but it requires that you understand the risks involved and how to manage those risks. All right, here's the chart of the S&P 500. Continues to be in the upward sloping channel that we've been in for a very long time. We're at the top of that channel, so this upward trend may be losing some steam soon, and it may be that we start 2015 with a little bit of a pullback. Now, if you know anything about history, the first month of the year, the first week of the year often paints the picture for the entire year. And so if we do see a pullback early in January, that sets up for a down year after really a great couple of years. For now, I think the market looks strong. No reason to not be a buyer of stocks, but the risk is getting higher because we are at the top of the channel. I felt a lot better buying stocks in the middle of October when we were at the bottom of the channel. Now we're at the top. We got to be more cautious. The Russell 2000 has underperformed the S&P 500. It has lagged the S&P 500 and is really getting stuck at the resistance from August. It is stuck inside that sideways trading range. There is a lot more potential in the small cap stocks that make up the Russell 2000. And so if we do see some profit taking in the large caps, we may see that money come into the small caps. But for now, this is a sector that is underperforming. It is getting better. There's starting to be more opportunities showing themselves here. And so I think this could be the hot market of the future, but for now, it is lagging. TSX has formed a falling top. At the end of last week, we saw some selling pressure in the oil stocks, and that dragged down the entire TSX. And what you get as a result of that is this falling top here, lower than this top, and if we continue to see some downward move this week, that would be a sign that the TSX is in a little bit of trouble. Why? Largely because of weakness in commodity stocks. Outside of commodities, Canadian market's not too bad, but those commodity sectors are really dragging down the TSX, and that has hurt the TSX Venture even more because the TSX Venture is heavily dominated by the mining and energy stocks in the junior sector, and that is moving to new lows, so you want to stay clear of this market outside of the very best of stocks that show their face in that market. Treasuries continue to move higher. That means bond yields are moving lower. That means interest rates are lower, and no reason to think that that trend is going to end because the green line on that chart, the upward trend line, remains intact. US dollar moving to new highs. That has hurt or helped to hurt the commodities. We've seen that for a number of months, and there's really no sign of weakness in that US dollar. So until there is a break of the upward trend line, you got to remain bullish on the US dollar, and that of course is bearish for commodities. Gold, there you go, downward trend line, falling tops over the last number of months, and this week broke down from a flag pattern. So we had the break below support 5 weeks ago, a little bit of a bounce back, that's the flag, and now this week we broke down. That points to lower prices in gold in the near term. Oil, big sell-off on the OPEC news, heavily oversold, way below the downward trend line. That means it should bounce soon, but it's like trying to catch a falling knife. So my sense is don't try to buy these things until they start to show some optimism, until the buyers start to come in. It's just too difficult to try and pick a bottom. I've tried and I've failed. The VXX showed a little bit of a jump higher. As we talked about last week, was at long-term support. We see it there a number of times, the VXX hitting support. So the fear index getting a little bit of a bounce, that coincides with the overall stock market at the top of its channel. That could point to lower prices, a little bit of a pullback in stocks in the near term. So I remain bullish on US stocks. There's no sign of weakness yet, but the market is risky. Neutral on Canadian stocks in the long term, but bearish in the short term. We had a breakdown this week, and that could be that breakdown from a falling top that leads to lower prices. On the gold and oil, bearish on both time frames. US stocks are in a strong upward trend, but at the top of the channel where the buyers tend to get exhausted. Canadian markets are being dragged down by weak oil. Gold is in a downward trend and having trouble finding bottom. Oil is very weak, but also emotionally oversold. Where's the bottom? Nobody knows, but certainly the farther we get away from the trend line, the closer we get to the bottom. Well, that has been the Stockscores Market Minutes for November 28th, 2014. Have a great week in the market and trade well.